to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth with Prof M. I am your host, Prof M, aka Mallory Meehan, and today I'm joined by Lane Kawaoka. Did I say that right, Lane?
Close enough. Kawaoka. Yeah.
Awesome. Well, thanks for joining us, Lane, and welcome to the podcast.
Yeah, thanks for having me. Aloha, everybody.
Yeah. So, Lane, why don't you start off by telling us a little bit about yourself, how you got into real estate, and then we'll kind of take some deep dives from there.
Yeah, so today we operate multifamily syndications and other investments in private equity. But just started out by myself. Previous life used to be an engineer, started to work that role and did that for a majority of the time while building my real estate portfolio in the beginning. So I'm definitely not one of these guys who flipped houses and does crazy things like that. And for I'm kind of the passive guy who did the engineering gig, who had a good salary, and then parlayed that into down payments for a lot of rental properties, and that's how I kind of got started.
That's awesome. And what year did you buy your first rental?
That was 2009. So I graduated college in 2007. So I saved up, I think it was like 80 grand back then to buy the house to live in. But back then I was kind of brainwashed to do the old 401k and buy a house to live in like everyone's supposed to.
Mm-hmm.
I think I got lucky because I was traveling all over for work as a young construction engineer. We traveled to different work sites and I was only home on Saturday. So in the beginning, I was like, why am I have this big house to myself? And I was like in my 20s. And I'm like, this is silly, right? Like this is
Mm-hmm.
before the days of Turo and all that stuff.
Right.
And I just called the old property manager or landlord that I had in college and didn't realize it. But apparently there's a lot of property managers out there. They take 10% of the rents,
Mm-hmm.
but they kind of do all the dirty work for you. And I was off and rolling and I was homeless and I just lived off the company dime. But I got that aha moment of like, wow, making a lot of beer money and a few months went by like this and I was like, whoa, wait, if I could just do rinse, wash, repeat and do this several more times, I'll be able to quit the rat race.
Yeah. No, I mean, I think that's awesome. I think a lot of people just don't understand that they don't have to buy a rental first to get started, but that, if it's a property that they're living in and they're like, this location isn't really what I want, or the size isn't really what I want, turn it into a rental and go find something else. Like, or even become a renter yourself and have investments, I think could also be strategic depending on what market you're in.
Yeah, I mean the hardest thing is like getting started the first one, and I think a lot of people, at least speaking for myself, like I was in Seattle, it's a very high priced area.
Mhm.
It's just hard to get started, because the numbers are so big, and now I live in
Right.
Hawaii. And especially over the last decade, like the prices of properties, like I used to buy little turnkey rentals for like 100 grand and rented for $1,000. And today those starter rentals are like 140.
Hmm.
You know?
Yeah. So what advice would you give to people who are maybe trying to figure out their first rental? Like what avenue would you suggest that they take?
Well, I think that for most people listening, you probably live in a place, even if you do live in the Midwest or Texas, you live in a place where it's just too expensive. Mainly like there's this thing called like the rent to value ratio where you take the monthly rent divided by the purchase price and you're looking something that's 1% or better.
Hmm.
So, places in Seattle, California, Hawaii, you'd be lucky to find a place in the ghetto for like 400 grand that'll rent for $2,000 a month. That would be 0.5%. No bueno, that's not going to work.
Yeah.
And that's going to push a lot of people to investing outside of their backyard
Hmm.
and less enviable areas. And we will grade locations and properties by ABC class. I'm sure most of us like to live in A-class areas and buildings,
Hmm.
but that's not going to be the best rental properties. There's sort of a sweet spot in that B class to upper C class property level.
Hmm.
You have more problems, more difficult tenants, but hey, that's the part of being a landlord.
Or that's the part of hiring a property manager to take care of that for you, right?
Yeah, yeah. So I that's what I did initially, right? Because I didn't want to deal with all that nonsense. And there's
Yeah.
a layer of legalities you want to kind of uphold, right? That I get it. A lot of people do it where they collect the checks, they're super cheap. They don't want to spend 10% of the rents every month. I think that's just a little narrow-sighted. A lot of those people might only have one or two rental properties.
Hmm.
I I was lucky that I was busy and I was constrained with time. So I had to get a property manager to do all this stuff. And plus I didn't know what to do anyway. I'm
Hmm.
sure like after a year or two you can figure it out, right? You start to develop a list of contractors and vendors and plumbers. But I think the idea is to scale, right? The people I work with, they make good salaries. A lot of these guys, multiple six figures. More importantly, you're able to save, 20 grand, 50 grand plus per year.
Hmm.
And that's was my situation. I was able to put away, 50 grand, 100 grand every single year to down payments. So by the time, I started to buy a few rental properties in Seattle, which now I know you don't buy properties in high priced areas like that because the rent to value ratio is horrible.
Hmm.
But in 2015, I had 11 rental properties more in the Midwest, like Birmingham, Atlanta, Indianapolis. Never saw those properties. It was just a pure numbers play. And I had remote property management managing the assets. That
That's
was kind of
awesome.
around 2015.
Yeah, I think that that's probably a strategy that most people are going to need to start thinking about is that you're not going to have the luxury of investing in your backyard. You're going to have to find those markets that are actually making sense numbers wise, because I think that's where people get into trouble. They buy a property, think it's going to be a great rental because it's in a great location, and then they're not even breaking even. And so it's like, well, what's the point of the investment if you're putting money out into that property?
Yeah. It bleeds like negative cash flow every single
Right.
month. But you know what?
Exactly.
Like that That's why I like real estate because you can have a really bad strategy like that, but still be better than most people investing in the stock market and stuff like that. Like it works, right?
Yeah.
Even if you are like the property should appreciate, you're getting the tax benefits, you're getting the leverage appreciation because you have a mortgage on it. I mean, it works, so I'm not gonna
Right.
knock it,
Oh
right?
yeah,
But
no, I totally get that. Yeah, it works. But I think that when you're thinking about starting in real estate, I think to your point, you need to really understand what is the rental value versus what you're buying it at, and to make sure that the numbers are making sense before pulling that trigger. Because in my experience and the things that I've seen, somebody makes a bad move in the beginning and they basically get turned off of real estate forever.
yeah, and you are gonna make bad moves. I made bad moves, right? That's
Oh
just part
yeah,
of
so have
learning.
I. Absolutely. Absolutely made bad moves. Okay, so you have now a portfolio that you have. Is it all just in the Midwest? Is that mostly where your properties are?
Yeah, I guess it would be more like the Sunbelt states, the southern states. Just it's more affordable out there.
Hmm.
I think the reason why we go there, we tend to stay in more of the red states because we want the landlord laws on our
Hmm.
side, better economic development out there, especially for the lower middle class. Like we focus in on workforce housing. So it's not luxury rental properties. It's more like that working middle class. So places like Texas, Florida, Alabama, Arizona, states like that. Um, we like to cluster our properties in certain areas so that we have, we build our teams out there. But, like I think a lot of people again will buy properties inside their backyard. If you live in a blue democratic state, not saying that's a bad thing. I live here in Hawaii, which is a very blue state. You have a lot of bad landlord laws
Hmm.
not on your side, going in the opposite direction.
Hmm.
So again, that's just gonna make things more difficult for you, if you ever needed to evict anybody, and I think that was kind of where I ran into issues with my 11 properties starting out. Started out good, but for 11 properties, it seems like a lot of properties. It really isn't in terms of cash flow. I mean, that just brought in maybe a few $1,000s per month.
Hmm.
Not gonna complain. Back then that was almost like a third paycheck a month. for me.
Yeah.
But and that was after expenses and everything, taxes, insurance. That's really how you calculate your cash flow.
Right.
But maybe an eviction or two every year, some kind of big catastrophe every quarter. It became sort of like sustainable, even if having property manager on all the assets.
Hmm.
And this is kind of where I realized now I was kind of growing as more of an investor, started to get around other accredited investors. And this is why like in a couple of weeks we have our Hawaii retreat where all the accredited investors come to Hawaii, we all hang out because that was a huge component for me to interact with more of these higher net worth investors. More people who had more than like onesie, twosie rental properties, but people who were
Hmm.
growing a pretty sizable real estate portfolio and net worth, over multiple millions of dollars. And it's just stuff you don't hear about, right? And the stuff I was hearing about, which we kind of teach today in the podcast and the new book, The Wealth Elevators, investing in alternative assets through syndications and private funds, the infinite banking, and then all these great tax benefits you get from investing in real estate with cost segregations, bonus depreciation to pretty much cut your tax bill. I mean, easily, I think in a third off of it. Some even down to zero.
Right. Yeah. So why don't you tell us a little bit about your syndication and how, maybe new investors could start out doing that versus maybe what we think like, oh, I have to buy a property by myself.
Yeah, so I mean, I think that the way to think about syndication is like the analogy I like to use is like an airplane. So in an airplane, you have the pilots up in the cockpit. They're the general partners. They're the ones that find the deal, do everything, line up the lending, use their relationships, and again manage it and distribute the funds to everybody who jumps on the airplane, who invests maybe 50,000, 100,000 each, and goes back and coach and takes a nap. And the idea, this is kind of where I realized in these types of groups out there, like a lot of people were just investing in dozens of deals out there. Um, you know, and the nice thing from a tax standpoint, obviously you get to partake as an equity investor and you get all the tax benefits, but you get this nice little simple K1 form. It's so much easier than, when you're doing rental properties, you have your Schedule E, Schedule C. It's very complicated.
Hmm.
You just get one little nice K1 form. And, I think this last one I had like 90 or usually about 100 of these K1s, which is super easy. You just give to your CPA and that's it. But these investors, they come in to coach and they're able to diversify to all these deals out there. So geographically different locations, as I mentioned earlier, but
Hmm.
also different asset classes. Like I personally like multifamily real estate because the population in America is growing. They're not making any more land.
Hmm.
The affordability issues. I think there's just like a new article last couple of weeks ago where right now, if you look at the average prices for a mortgage, the taxes and insurance is now more than the actual mortgage is
Yeah.
absurd.
Yeah.
Which
Especially if you're in a state like Florida.
yeah, which speaks to um, you know, more and more people aren't gonna be able to buy houses to live in. They got to be lifelong renters, and
Mhm.
that's where we are kind of beneficiaries of that. Um, I think when Bush took over, they had this idea where everybody deserves and is entitled to own a home, and they created all these crazy lending programs that gave money to people with a heartbeat, and that obviously created a lot of problems.
Mhm.
But I think we're kind of settling in this position of like we're becoming a nation of renters, and the population is increasing, especially on the lower end, which
Mhm.
is kind of where our investment thesis is kind of this lower workforce, middle class of rental properties that rent for $900 to $1,200, just to
Mhm.
put a price out there.
Okay. So are you doing new development for these multifamilies or are you buying existing buildings?
We do both. Initially when we got started, like we would buy a lot of these smaller Class C properties, so rougher tenant base, older properties. So that'd be like 1950s, 1980s. We made a lot of good money doing it that way, but it is more riskier and much more of a headache. In these types of realms, your tenants will, they're always going through tough times, these folks. And
Hmm.
we had some good projects that our collections are like 80%. And we bought it at a good price and we did enough value add, so construction to the assets. new flooring, new appliances, new paint job, playground equipment, new roofs, new parking lots, those types of physical improvements to bump the rents. But later we gravitated more to larger Class B assets, 100 unit, 300 units. But in 2020, we started to develop our own, because even in those nicer Class B assets that are built 1980 to 2000, you still got tenants, right? It's like
Hmm.
people are always the problem.
Yeah.
So, with the new builds, it just seems to be, you just have to get through the construction,
Hmm.
and then you have a lot cleaner tenant base
Right.
there. So we also kind of do that, but in that vertical, we're limited to the land that we buy. So, we need about 20, 30 acres of land, but more importantly, in the path of progress. It can't just be out in the middle of nowhere.
Hmm.
And you can't buy that in like the city center or, within the loop tracks of any metropolitan area. So we take what we can get. We do it just a handful of those projects, but yeah, all verticals, the multifamily value add, which I mentioned earlier, the development, and now we're buying businesses in the private equity side.
Oh, love that. Tell me more about the business buying.
Yeah, so 2022, interest rates got jacked up. They are coming down slightly now, but I would say they're still about maybe 10, 20% off of the highs. So right now, it's kind of a great opportunity for people to get involved into commercial real estate because the prices are down 20 to 30% of what it was just a few
Hmm.
years ago. But the interest rate, it's always people understand like it's always a play between the interest rate and the prices, right?
Right.
And if your interest rate is high, which it is now, you can only pay so much
Hmm.
in your, when you're underwriting. So we're still in that point, right? So if you're buying properties cash, which isn't always the best thing, right? Because you want to use leverage in real
Hmm.
estate. Um, you could get great deals right now, great prices, like I mentioned, but it hasn't come yet where the equilibrium has gotten to a point where the interest rate is low enough combo with the price. I don't think you'll ever get there, right? That's what a market cycle is, right? Right
Right.
now is kind of the bottom of the market cycle,
Hmm.
when ideally people want to get in if they see the signs.
Yeah.
But this is, as Warren Buffett says, this is when there's fear in the streets.
Yeah.
So if people are you know, want to save this podcast recording and call the bottom, this is almost like 2010, 2012 again in the commercial real estate world. Very different than residential real estate, I would say. But
Yeah.
um, long story short, we stopped buying in 2022 for at least a couple, 2, 3 years because the interest rates were high and we're still in
Right.
that state. So, we, at the end of the day, we look around for good opportunities, whether that is a piece of real estate or a business, could be like a plumbing business, HVAC business, or more professional services business, like a digital marketing agency, a CPA firm.
Hmm.
At the end of the day, that in essence is what the wealthy do. They buy assets
Hmm.
and they increase it. Now, the difference between the way the society wants us to invest is through all these Wall Street products, huge hidden fees. You barely get any of the upside, right? Like REITs, for example. REITs invest in real estate,
Hmm.
the same kind of assets that we invest in, except the REITs have a gazillion middlemen and a financial plan, and they're taking your money.
Hmm.
And this is why early on with the rental property, as I was like, I'm making like 20, 30% of my money and not really doing anything. I'm not flipping houses. They're just buying and holding.
Right.
Why the heck would I want to put my money in the 401k and suppose to get 8%? Like, who took all my money? Well,
Yeah.
why else do you think Wall Street has these big buildings?
Hmm.
Um, so, these big companies out there, they invest in businesses too, right? They acquired. I mean, that's basically what Warren Buffett does. He
Hmm.
acquires M&A. And this is exactly what we're doing, but more on the micro scale. And more, investors are able to get more directly closer to the action in a way.
I love
So
it. So are
this
you
is,
doing like syndication models for these businesses, or how is the structure working for those acquisitions?
yeah, same thing. I mean, the way the org structure kind of works, or the entity structure kind of works, is you have a investor base that owns part of an asset, whether that's a piece of real estate that has the title or own in a business. It's kind of virtual, right? It's you own a business.
Hmm.
You have your general partners that manage it and also have a share too, carried interest, but that, money is pooled together legally. We use a regulation 506C offerings, which take in accredited investors. And, we'll typically bring in, anywhere from like a dozen to, I think we've seen like 150 investors in one deal, and raise the capital that way. It depends if you're raising $1 million or $12 million. Um, but it's kind of a cool thing, right? Because I think like initially when we got started in this, like the real estate brokers are like, what? Like, where are you getting this money from?
Hmm.
And it, the general attitude is like, well, that's pretty cool, right? Because normally we these good assets, the great finds, great deals are only accessible to the big guys,
Right.
right? Because they write the big checks, and more importantly, they're more connected.
Hmm.
So essentially, quietly, a lot of accredited investors out there are able to tap directly into deal flow and get institutional quality deals, right? You just got to team up with some other accredited investors.
Yeah. So I'm interested to hear how you first started kind of like building this business up. Like you started out on rentals yourself and then kind of transitioned. How did you make that transition?
Yeah, I mean, I probably would have just still working my engineering job today, just hiding out. Um, for sure. If it weren't like I started a podcast back in 2016 when nobody was doing a podcast. But back then we were teaching people how to buy little rental properties. It's kind of I was
Hmm.
talking earlier,
Yeah.
find those turnkey rentals where you're remote, you're passive, and you're just doing it yourself. And then that's how you're able to grow your net worth to $1 million or greater. So I think for at least the first couple of years, from 2016 to 18, we built a community around that. Started to teach people how to do that. So if people want, they can go to the website and get access to that free remote rental e-course in there with the analyzer and everything. That's all free on the website. It's not really the core content that we teach today. It's kind of more for the non-accredited investors getting started, but
Hmm.
that's how initially I got started growing this base. And then naturally, at that point in time, I was getting more serious about selling off my little single family homes and going into more of these syndications and private placements. Obviously, the podcast material changed, and then it got more sophisticated on the taxes side as these newer investments allowed for better tax write-offs and
Hmm.
expenses and things like that. So just kind of naturally, organically grew. And it was a time before there were a lot of podcasts out there after 2022, I think. So I didn't realize, but people just, I don't know, trusted me and they just wanted to invest alongside. And that's kind of how we started. Initially, I think now all over 900 individual
Wow.
investors is crazy.
That's
Yeah, the power of
great.
the internet.
Yeah. No, that it's the power of knowledge. And I think that people who want to share knowledge and who, people can trust, I think that's exactly, a sentiment to you of how good you did while starting that podcast. So kudos to you on that. I have a question. If you can, I mean, I think I know the answer to this, but I want you to kind of clarify it for our listeners. When we're talking about accredited investors, what kind of qualifies that as an accreditation for you specifically? Are there any like ways to get around that or programs that you offer for non-accredited investors too?
Yeah, I mean, it's nothing that formal, really. I mean, it's kind of like, you're pregnant or not. It's not really like if you want to print out a certificate, you can, I guess. But essentially, the way this is kind of, I mean, I see why the government does this, right? They don't want the average Joe who's broke to invest, 50 grand of money that he doesn't have into some one of these projects, right?
Hmm.
So the way that they have it set up is like you have to be somewhat of a wealthy person, right? You have to have a net worth of $1 million, or like what we have is, a lot of these younger guys don't have the net worth of 1 million, but they make 200,000 a year.
Hmm.
A lot of these guys, they make that right out of college with some of these engineering degrees and doctors and dentists. Um, So you can either qualify on the net worth side or the income side, right? Um, but I think in the beginning we did like non-accredited investors, but to me, like especially doing this so long, I just kind of realized that only accredited investors should be doing this.
Mhm.
And if you're not quite there yet, you know, unfortunately, a lot of people are in this like no man's land of like maybe $500,000 net worth, then you make $100,000 a year. I mean, that's kind of where I was at personally, but that's where you have to slug it out with these little rental properties, grow your net worth over time,
Mhm.
and then step up to the big kid game at some point. But I think that's why I wrote my book, The Wealth Elevator, because there's different floors to the wealth elevator. There's different paradigms that you go through, and that was kind of all the steps that I went through. You buy little rental properties in your backyard, then you buy it out of state, then you cluster them, and then you go to syndications and private placements. And then as I'm learning, there's different, what do $20 million families do? What do $100 million families do? Like I didn't have any accredited investor aunties or uncles or friends growing up. My parents didn't even own rental properties themselves. I had to learn this all by myself. But to understand through like a construct of like there's different floors to
Mhm.
this game because there's a lot of books out there for like Dave Ramsey, Susie Orman, like that's more for like the basement level, right? Getting out of debt, basic
Mhm.
personal finance. And then there's the Rich Dad books, which I think are great for mindset, but you don't really know what the heck to do. There's no action plan in it. And that's what I wanted to create was like based on what floor you're at today, whether you're a non-accredited investor, whether you are a credit investor, where to kind of start out, right? Basically what cattle grade you're at and what do you do?
Love it. So, The Wealth Elevator is your book, and where can people find that book?
They can go on Amazon and pick it up. If they do buy a copy, let us know. We can share with you the MP3 PDF version for free.
Awesome.
Um, but yeah, I mean, it's a short read. There's a table in there. It's obviously written by engineers, so there's a table in there that kind of quickly identifies which floor you're on, and
Mhm.
then I think it's important to kind of understand the floor next. Um, that's next up. If I would have known more, I probably wouldn't have bought 11 rental properties. I probably would have stopped at maybe a few.
Mhm.
But hey, it's all in hindsight, right? You
Hindsight's
you learn by
2020.
doing.
Right. Exactly. Exactly. Well, Lane, this was so great. Are you still doing a podcast as well?
Yeah, we still do one every week. I don't know what I continually talk about. I guess there's always something new.
Well,
But
if people wanted to check out your podcast, what's your podcast?
yeah, they can go to the Wealth Elevator
Okay, perfect.
podcast. We talk a lot about taxes, infinite banking, and then, investing in real estate or now private equity. But like I kind of jokingly said earlier, like it's not that difficult, right? Like when you're a
Hmm.
passive investor, there's not too much to it. I really think what you really need to do, I mean, yeah, of course, come to the website, get some of these free courses that we have, the masterclass, the 12 series masterclass that we have for free, and then the book. But I think you really got to get around other accredited investors because at the end of the day, it's like a relationship game and it's a small world out there of investors doing this.
Yeah, absolutely. Absolutely. Well, Lane, thank you so much for joining us. And do you have any final thoughts for our listeners?
Um, no, no, I think I don't know if I can send you the PDF with the MP3, Mallory, if people
Perfect.
want to email you for it, they can get
Awesome. Or
that
we
and we
can
can
put it
have
in the
that via.
notes below for the podcast and people can check it out. And yeah, make sure to check out the Wealth Elevator podcast as well.
Yeah. Thanks for having me.
Yeah, thanks for being on our show. And that wraps it up for another episode of Inspire Wealth. I am Prof M out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.